talk to Mark Mathews. Mark Mathews, good morning. Thank you for joining us. Just one of those days where we think a day trader should not trade, purely looking at the trends. But Mark, what we're debating now is no longer inflation. We are not talking about the degree of recession. What do you think markets are pricing in? Everybody is pricing in a slowdown, but the question is how much of that slowdown would be real and how much of that slowdown would be temporary? What is your sense?
My sense is markets are not pricing in a recession. Otherwise, you would see rates falling. They are pricing in a slowdown, and I think they're correct to do that. The U.S. economy has been incredibly resilient given the speed of the rate hike cycle that we've had since March. And there's several reasons for that. I think most importantly is that low and middle end labor, for the first time in generations, has wage bargaining power. This is a function of millions of largely older people having dropped out of the workforce during COVID and they didn't come back. And so that wage price increase has been able to shield the consumer from the worst of inflation. But going forward, I would like to say we are firmly of the view that inflation will come down, and that is the most important thing because we believe it will allow the Fed to stop this rate hike cycle, and we think that messaging will come out in the December meeting.
They say you should never fight the Fed. Now, do you think Fed, in a sense, here has just been stubborn? They are digging themselves into another hole. First, they denied that inflation was coming, and now they are not accepting that inflation will peak out. I mean, it's like saying that I'm shooting self-goal after one another.
I think they're worried that if they signal victory now, the assets will all whip back up, property and stocks, and that in turn will drive inflation up. So they don't want to do it now because even though there are absolutely signs that even the stickier items like healthcare and rent are coming down, I think they just simply think it's premature to do that, and they're probably right. But on the other hand, when we do get increasingly more data showing us that's the case, and as I said, I think by December, we won't have just evidence, we'll have real proof that the inflation is down. Then they can soften their rhetoric. I think doing it on the November 4 meeting would be premature because the dot plot was just revised up in September. But December 14 meeting, I think, will be the important one for signaling that the rate hike cycle is ending.
Mark, I'm wondering how you're reacting to all the commentary coming in from Biden saying that he doesn't think there is going to be a recession. If it is, it'll be a very slight one. That is that the US economy is going to move down slightly. But, you know, like we were talking about earlier, for the US economy with its mammoth size, for it to move down slightly also means a lot of ripple effect for the rest of the world.
Well, there's the degree of recession, I mean, the magnitude of the decline in GDP, but then there's also the duration. And number one, I'd like to say that I agree with him. I do not think there will be a recession. If there is, it'll be a very small one. And I think the one in our recent experience that would be most appropriate to compare would possibly be 1990. Where you had a recession that lasted just a few months. I don't particularly remember how many, but it was certainly less than 12 months. And it was a function of the oil price shock following the first Gulf War, and a little bit the savings and loans crisis in Texas and some of those other states. Anyway, what I want to say is that it was shallow, it was short. And at the time, you kind of felt it. I actually kind of remember because I was trying to find a job back then. It's actually how I ended up in Asia. But it ended quite soon. And I think that this will be the same in the sense that we have had a commodity price spike, but it's coming off now, we believe. And at the same time, as I said earlier, the labor market in the US is simply so strong. It would be highly unusual to get a severe recession when employment is still this strong.
Usual for a recession. So, Mark, morning, where does India stand in all of this? Because we've been banking on the China plus one factor, the crisis in Europe with respect to gas. Now that we're seeing an opening up of China, does that leave India in a bit of a vulnerable position, although things do still remain unknown in that region?
Well, we're not seeing an opening up of China. There were two editorials in the last 2 days in the People's Daily, which is the Communist Party's official mouthpiece, and another one in Xinhua, which is the government's official media. All three were supportive of the dynamic zero COVID policy, and I think very strong signals that it will not be removed after the party congress kicks off on Sunday. So they're not opening up. In fact, I just read this morning that, let me get the note here, they've just hired 950 people in Shanghai, the Shanghai municipal government, on a 2-year contract to enforce dynamic zero COVID, 2-year contract.
Mark, let me be a compulsive critic here or a naysayer. The war is not, in a sense, resolved. The energy crisis, if at all, OPEC will ensure that prices do not come down. And whether it is soft landing or recession, the fact that world will slow down. We are staring at what could be called as a maze of issue, both in terms of demand and energy challenges, at a time when we are moving into winter. Winter has just about kicked in. So what should we expect in terms of inflation dynamics, demand dynamics? Because it could get ugly, it could get messy, and it really could get dark in Europe.
Well, I must confess that you're right to say there's so many moving parts. It's extremely complicated. What I think we're going to get over the next couple of months is a softening in the sticky price items that are represented in the core inflation. I just mentioned rent and healthcare earlier. I think we're going to get significant drops in the health insurance contribution to CPI in particular, which is a bit of an accounting anomaly that I can't go into it now, but it is going to happen. And the rents are coming down, as I said. So you'll see a softening in some of those ones that were actually the ones the Fed was more concerned about, and perhaps not so much of a softening in the more flexible items that have been coming down, like commodities, because, as you say, OPEC Plus has announced this supply cut. Now, let me just say the 2 million barrels per day includes the oil that Europe has already said they wouldn't have bought from Russia anyway. And a lot of the OPEC countries will have trouble meeting the quota, and as it is. So we think it's probably more like 1 million to 1.2 million barrels per day that OPEC Plus will be reducing, which is still material, but it's not as much as 2 million barrels a day. And adding it all up, I think we could be looking at about $80 a barrel, which is lower than it is today, but not dramatically lower. But I'd also say that oil is not as important as it was, say, 10 or 20 years ago for the economy due to technology. We have, to a degree, including India, weaned ourselves off of it as being such an incredibly important component to making everything work. Just look at what we're doing right now. We're having a conversation. I don't think we're using oil. And in the old days, I'd have to, take all sorts of transport to go over there to see you and come back.
Mark, what about in India, the fact that we are seeing that gap widen between the DII buying and the FII selling? Does that emerge as a bit of a worrying trend as we're seeing that picking up?
I've always felt in every country, including India, it's much better to have locals liking the market than the foreigners, because the foreigners, let's face it, they're hot money. They will run away in a crisis. That's the home bias that every single country has. So I'd far rather see the locals liking their market because of that, as I said, a risk of the foreign money departing when times get tough, but also because the locals know the market best. And so for me, when locals are buying, that's a vote of confidence from the people who really know what's going on. For example, you might have seen Tata said they're going to be investing a lot of money in India. I was so happy to see that, because that's the kind of news you want to see. Locals putting their own money in the market. So no, it doesn't concern me.
All right. Thank you, Mark, for sharing with us your outlook. So that's the view coming in on the US markets. As of now, not pricing in any sort of a recession.